Will crypto moon or vanish? The 2025 verdict is coming, and today we're going to unpack what will decide crypto's fate without hype and without doom. We'll look at market cycles, real-world adoption, what regulators in the United States and Europe are actually doing, why Hong Kong and Singapore matter so much for licensing, what China's tech giants would like to launch, and the surprisingly big question of whether Bitcoin belongs in your 401k, that's your employer-sponsored retirement plan, or your IRA, an individual retirement account. This is what will decide crypto's fate, and possibly whether your retirement party includes a gold watch or a cardboard sign saying, "We'll code for food." Let's start with the pattern that keeps repeating. Crypto tends to move in cycles, dramatic surges led by narratives like digital gold, decentralized finance, or spot Bitcoin exchange-traded funds, and then painful drawdowns when the story gets ahead of adoption. Think of it like dating someone way out of your league. You post all the cute couple photos first, then 3 months later you're explaining to your friends why it didn't work out. The interesting part in 2025 is that under the surface there's more plumbing than ever. Better custody, clearer rules in some places, and big-name companies experimenting with payments and tokenization. Regulation is no longer a hypothetical, it's becoming code. In the United States, the biggest shift this year has been federal action on stablecoins and retirement investing. Congress passed the Genius Act, short for Guiding and Establishing National Innovation for U.S. Stablecoins, creating the country's first federal framework for dollar-pegged tokens. It sets who can issue them, what reserves they must hold, and which regulators supervise them, including the OCC, the Office of the Comptroller of the Currency. The law aims to align state and federal rules so issuers can scale without regulatory whiplash, because nothing says innovate like answering to 3 different regulators who can't agree on the font size of your disclosures. Early signals from industry say household name banks and retailers are exploring their own dollar-backed tokens. But implementation will take time because agencies still need to write the detailed rules. There was also a high-profile executive order from the White House directing agencies to democratize access to alternative assets in the 401k system. Again, that's the employer plan many Americans use for retirement, explicitly naming private equity, real estate, and cryptocurrency. To be clear, crypto was never legally banned in retirement accounts, but most plan sponsors avoided it because of fiduciary risk and operational headaches. The order tells agencies to reduce barriers, clarify how fiduciaries can evaluate these assets, and ease litigation fears, without removing their duty to act prudently under ERISA, the Employee Retirement Income Security Act. Translation: the government just said, you can let people drive faster, but also, by the way, you're still responsible if they crash. Europe is moving on a parallel track with MiCA, the Markets in Crypto Assets Regulation, now live as the unified rulebook for the European Union. MiCA sets licensing for crypto asset service providers, often called CASPs, rules for stablecoin issuers, and disclosures for tokens that aren't securities. The European Banking Authority, EBA, and European Securities and Markets Authority, ESMA, are rolling out the technical standards. Meanwhile, the EU is pairing this with tighter tax reporting through the Crypto Asset Reporting Framework, or KIAF, and DAC 8, so cross-border holdings don't slip through the cracks. Basically, Europe is telling the crypto industry, yes, you can build here. Just fill out these 187 forms in triplicate. Now, the licensing story in Asia is just as important. Hong Kong has rebuilt itself as a regulated virtual asset hub with licensing for virtual asset trading platforms, or VATPs, run by the Securities and Futures Commission, SFC. They're proposing to expand mandatory licenses to cover custodians too, the folks who actually hold your crypto, so there's oversight from wallet to matching engine. That's a big deal because historically, custody failures have done more damage than bear markets. Or, as many investors have learned, prices can go back up. But your hacked coins aren't coming back. Singapore, under the Payment Services Act and the Monetary Authority of Singapore, MMAS, has a similar approach. Licenses are possible, but hard to get. Think of it like auditioning for Broadway. You can make it, but you'd better have your compliance choreography down cold. EMAS requires top-tier anti-money laundering controls, onshored systems, and operational resilience before you even think about scaling. China is a different story. Mainland retail trading is banned, but big tech sees opportunity offshore. Reuters reported that Alibaba's Ant Group and JD.com have pushed for a yuan-linked stablecoin in Hong Kong pegged to the offshore renminbi, RMB, to counter US dollar dominance. At the same time, regulators are telling domestic brokers not to hype stablecoins, basically saying, "We're building the car, but you can't joyride it on the mainland." Now let's talk about Bitcoin in your 401k or IRA. The bullish argument, diversification. Bitcoin's returns have historically been uncorrelated with some traditional assets over longer timeframes. Inflation hedge, the fixed supply narrative appeals in a world of endless fiat printing. Accessibility, putting it in a tax-advantaged account, could standardize custody and investor education. And for younger savers, buying a little each paycheck could smooth out volatility. Plus, in a 401k or traditional IRA, you're not paying taxes on interim gains, which means you can ignore the annual IRS gotcha and focus on the long game. The bear argument? Volatility. 50 to 80% drawdowns happen, and no one wants their retirement balance to resemble a Six Flags roller coaster. Fees, crypto products often cost more than stock funds, and if you're paying 2% a year for the privilege of watching Bitcoin dip, that's a problem. Valuation. Plans need rock-solid pricing and rules for forks and airdrops because nothing says Monday morning HR nightmare, like explaining to 5,000 employees why their accounts have mystery coins. Fiduciary duty. ERISA still applies. That means sponsors must prove they acted prudently, documented the decision, monitored the asset, and educated participants. This isn't a throw it in and hope for the best situation. On the operations side, you want qualified custodians, regulated entities that hold client assets, with cold storage, insurance, audited controls, and disaster recovery plans. No trust me bro wallets. And under no circumstances should plan assets be lent to affiliates or parked in a CEO's personal ledger. Globally, regulatory clarity is moving faster than ever. In the US, the Clarity Act, Digital Asset Market Clarity Act, would give the Commodity Futures Trading Commission, CFTC, a clear role over digital commodities like Bitcoin, leaving securities like tokens to the Securities and Exchange Commission, SEC. In Europe, MiCA plus CAF is setting unified standards. In Asia, Hong Kong and Singapore are building what could become the compliance spine for East-West flows. If all of that comes together, crypto's next chapter could look less like a speculative carnival and more like a grown-up financial market. So, will crypto moon or vanish? The 2025 verdict is coming, and it won't be decided by price charts on your favorite trading app. It'll be decided by licensing checklists, custody audits, reserve attestations, and whether your HR department can add a crypto option without triggering a lawsuit. It'll be decided by whether stablecoins become serious payment infrastructure or just new casino chips with corporate logos. And it'll be decided by whether retirement plans treat Bitcoin like a sensible sleeve in a diversified portfolio, or like a dare. If you're in this space, treat crypto like a technology investment, not a lottery ticket. Size it to your timeline, demand institutional-grade custody, and let regulation work for you. If the US and EU stay the course, if Hong Kong and Singapore complete their licensing arcs, and if China's tech giants channel their ambitions into regulated offshore projects, the next cycle could be progress. If not, well, that's why we diversify. As always, this isn't investment advice. If you found this helpful, hit like, subscribe, and drop your thoughts in the comments. In your portfolio, is crypto a small satellite, a core holding, or a hard pass? The verdict isn't in yet, but at least now you know what to watch. And maybe how to keep your retirement party in a steakhouse instead of a food truck.